You're staring at a 4-hour chart. The indicators are screaming to buy. The central bank newsfeed is hinting at a sell, and you're feeling the isolation of the solo retail trader. Imagine looking over the shoulder of someone who has maintained a 15% annual return with low drawdowns for 3 years, and having your account automatically mirror their every entry and exit. A decade ago, this meant waiting for a signal in a chat room and usually missing the move. Today, execution happens in milliseconds through API-driven ecosystems integrated directly into the market's plumbing. Despite the automation, this is not a hands-off money machine. Treating it as a set-it-and-forget-it system is a reliable way to lose your initial investment. Success in this environment requires the specific skills of managerial oversight. Your daily routine shifts from executing individual trades to selecting and monitoring the people who do. In social trading, you survive by losing your focus from reading candlestick patterns to vetting the consistency and emotional discipline of other traders. Managing that talent starts with understanding the ecosystem. Copy trading is the automated engine that replicates the orders. Social trading is the dashboard providing the context, the news feeds, and the rationale behind those trades. This proportional equity model is the mathematical baseline. A master trader with a $100,000 account risks exactly 1% of their capital. The system calculates the equivalent risk for your $5,000 account, scaling down to a 0.05 lot trade. The percentage of risk remains identical, but the math faces a physical hurdle: slippage. This occurs when the master gets their fill price, but the market moves slightly against you in the milliseconds it takes for the signal to reach your broker. Over hundreds of trades, losing just 1 or 2 pips to slippage can turn a winning strategy into a losing one for the follower. This makes execution speed and low spread accounts a technical requirement for any manager. Even with perfect technical execution, the system only works if you allocate your capital to the right strategy providers. Most amateurs fail because they sort leaderboards by the highest monthly return. This often highlights gamblers who have simply survived a streak of high-risk trades. To find professionals, you have to look at maximum drawdown. This metric shows the largest percentage drop a trader has experienced. A 70% drawdown indicates a strategy that relies on luck. Professional managers generally keep this under 20%. Consistency also requires time. A 6 to 12-month track record proves the trader can handle different market regimes, from low volatility ranges to high-impact economic news. Check the average trade duration. High-frequency scalpers are the most vulnerable to slippage. Swing traders, who hold positions for several days, offer the most reliable results when mirrored across different brokers. Using these metrics to filter providers is what distinguishes a disciplined portfolio manager from a retail speculator. A manager's goal is to minimize the impact of any single failure. This is why the safety buffer strategy dictates that you never allocate 100% of your capital to one trader. You can structure a balanced portfolio by splitting your capital: 50% to a conservative anchor, 30% to a trend-following aggressor, and 20% to a niche pair specialist. Watch for the Martingale Trap: traders who double their position size every time they lose. Their equity curve looks like a smooth upward line until a single losing streak causes a catastrophic wipeout. You face a similar risk if you artificially multiply the master's risk on your own account. Setting a 3-to-1 risk ratio might increase gains, but it ensures a margin call during a routine drawdown. To protect your total balance, set a circuit breaker. This is an equity-level stop-loss that automatically disconnects all master traders if your account value drops by 15%. When losses occur, the responsibility rests with you. The follower must take accountability for the talent they choose to hire and the risk limits they set. Social trading bridges the gap between individual isolation and collective expertise. Success is found through the discipline of the process, rather than the search for a perfect trade. You can begin building your own roster of traders today. Join the community of managers on FXNX.